The financial crisis is way bigger than anybody is talking about. Banks are in free fall. Today, I'm making big market predictions for where we're going in the coming days, where the market bottom could possibly be, and where we could end this year. In my view, this is an important video. I encourage you guys to take notes. This is the Stocks with Josh show. Like and subscribe and join the best community on YouTube. But watch out for the scammers. They use my picture and my name and they impersonate me in the comments section. They try to get you guys to DM them on WhatsApp and Telegram. It's not me. Last Thursday, I posted a video titled, "It's Worse Than You Think," where I called First Republic stock FRC out. I said it's over. The stock is worthless. Essentially, sell, sell, sell. And that turned out to be one of the last days that people could actually get out of First Republic. By Friday, nationwide news was saying the exact same thing, and by Monday, it was over. I led off in that video a funny clip of Mr. Bean being silly in a doctor's office, and he represented Bitcoin, and he was sitting next to a patient wrapped head to toe that represented the banks. And the point was that what's bad for the banks is good for Bitcoin, and that also marked the beginning of a pop back up in Bitcoin. In addition, and this is the important point for today, I warned about the regional banks and the trouble that was yet to come. Now check out this clip. Covered First Republic, which is a regional bank, down on its luck. But how are all the rest of the regional banks doing? For that, let's check out the SPDR S&P Regional Banking ETF, ticker KRE. Now, this chart looks nearly identical to FRC. Why isn't Wall Street swooping in and buying this amazing ETF on a 30% discount? Well, this chart is just as sad as First Republic. No dead cat bounce, nothing. Looking like a dead man's EKG, flatlining. Still falling and looking for a bottom. And in just a couple days later, the floor has fallen out for the ETF KRE and the regional banks. Since then, KRE, representing an entire stock sector, has broken to the downside an additional 10%, bringing it down 40% in just the last couple months. And other large regional banks have been free-falling, with trading halted to the downside. Western Alliance Bank Corporation fell an additional 30%. PacWest Bank Corp fell 33% in a single day. Of course, yesterday in my video, I titled "Someone is Lying." I called out the government and big banks for sending the message saying everything is fine, when in reality, the national economy is on fire. This affects you and me. Regional banks provide the majority of loans and lines of credit for small businesses, and half of all workers in the US work for small business, which means that the Fed is actually going to get his wish: higher unemployment. In addition to all that, most people do not understand that what the Fed's rate hikes have done to the bond market. Bonds are the safe investment. They make up the absolute majority of the banks, the 401k pension funds, and the life insurance companies' investments. And I've been sounding the alarm that these entities that hold your money have lost it in the form of unrealized losses. Make no mistake, there is serious issues of insolvency in the nation. Pension and life insurance companies have trillions of unrealized losses right now. All of this has been caused by the Fed's fast-paced rate hikes, which he added an additional 0.25 to yesterday. He has simply gone too far, too fast, and the aftermath is coming. I want to take a brief moment, and I want you guys to watch this short clip of him talking about the credit crunch yesterday.
We've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates will, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted, but that's what we'll be watching carefully to find out.
Out of his own mouth, he says, honest and humble for a complicated task. That means that these guys are going to be breaking stuff. It's going to hurt. And nobody is smart enough to know exactly what the outcome will be for those decisions. Well, I'm going to break down the problem and the solution, but before I get into that, Quick station break. If you need better trade tools, check out the offer from the Moomoo investment app. You can get right now up to 20 free stocks. This is a limited and exclusive offer available for the month of May. You can click on the link to get all of the details. Now, I specifically use Moomoo every day. I like their earnings calendar. Plus, after a company reports, you can click on that earnings tab and you can get a quick overview of the details for their earnings performance. Best part of Moomoo though is the chat group I host on the app called Stock Josh Fam. Get your free stock, start investing, and then come find the chat. All right, back to the economy. Do you have a life insurance policy? Mom, dad, grandma, grandpa, they've responsibly prepared to leave something behind for the next generation, but insurance companies are in big trouble and they're underwater in their number one investment, bonds. Are you counting on a retirement fund or a pension? Let me tell you, they're the biggest losers, missing trillions. Someone will say, Josh, this is some serious FUD. Now, I wish it was, but honestly, it's not. Does this mean that everything is going to crash and burn? Well, the answer is not that simple, and it's really no. All of this is just the backdrop leading us up to the U.S. hitting its debt ceiling. And on that note, Yellen came out recently changing her usual message of everything is fine to we're in big, big trouble. Treasury Secretary Janet Yellen notified Congress on Monday that the U.S. could default on its debt as early as June 1st if legislators do not raise or suspend the nation's borrowing authority before then and avert what could potentially become a major global financial crisis. Why has she gone from everything is fine to we're in big trouble? Because we're getting very, very close to the solution to all of this. The powers that be have backed this economy into a corner so that they can get back to what they love to do the most. And I think you guys know what that is. It's to print the money, money, money. And when that happens, crypto and stocks will fly again. That's why we've been steadily moving up for the last 6 months. It's in preparation for that. In December and January 2023, we were in the buy zone and the smart money bought. Most of retail is going to miss it. They missed that opportunity and they're going to miss the next because they think that the markets are going to go lower than they really will. Truthfully, smart money has already told us how this year is going to end, which is largely flat. I read to everybody Goldman Sachs' annual investment letter at the beginning of this year in January. And these guys said that the terminal rate would be likely 5.25, that's where we're at, and that the year would end around 4,000 on the SPX, which measures the S&P 500. When we get down to 3,600, all of retail is going to think that we're headed to sub 3,000, when that's probably going to be the time that people should be buying. Phrases like mother of all bubbles, everything bubble will keep retail at bay during one of the greatest wealth building opportunities of their lifetime. Let me give you guys an example of how the public or retail traders get misled. The lunatic politicians have virtually destroyed the dollar with excessive spending and printing, but most Americans have no understanding of the economics, and as a result, they continue to get behind whatever party they follow and whatever good cause that's marketed by that party. For example, remember the politicians created an Inflation Reduction Act, which was a bill to spend trillions of dollars. Easy money created inflation, and Americans applauded more spending under the well-titled name. Both parties do it though. So they're going to print our way out of the crisis because it's always what they wanted to do. And that's going to cause stocks to rise. So let's take a look at the S&P 500. I'm going to let you guys know a scenario that might play out. If we accept the fact that October was the low in the S&P, that it was the lowest low, and that they, the powers that be, will take this economy back to an easy money environment, then we're simply looking for a higher low, which would give all of the big tech stocks an opportunity to get back to being oversold again and becoming a great investment, but not as low as they had gotten between October and January's lows. All right, we're looking at the S&P 500 on the SPX chart. I'm using the 3-day candlesticks, and we're looking at the Gaussian channel. Nice and easy red-green scenario, but here's what I want to point out to you. We're currently looking at the 2008-2009 Great Recession. I'm going to go through that as well as a couple other recessions, and then we're going to compare it to where we're at now to see if we could see any similarities or potential possibilities of how the market might behave. When the market breaks through to the bottom of the channel, let's start off right here, right? it came and it tested the bottom of the channel, and it got this bullish tail, which drove it back to the top of the channel. This actually gave us back in 2008 a double top, right? Then it skimmed along the top of the channel until eventually it broke down and it went back to the bottom of the channel. Now, at this point, there was still the possibility that this could come back up. It came to the middle of the channel, and at that time, we got these two really tall wick bearish candles, which gave a pretty strong signal that this was not going to continue higher and go to the top of the channel, meaning that that would be the end of this pullback. Instead, it never really broke through the middle of the channel. It got rejected, and this created a move beneath the channel. Now, I'm going to point something out to you guys as we go forward, that whenever it gets beneath the channel, when it eventually breaks all the way to the top side again, it typically is an indication that the worst is behind it. It then moved back up and it got rejected at the middle of the channel, which was super bearish. It came back underneath. It got rejected at the bottom of the channel, which was also super bearish. We have a head and shoulders pattern here. And so when it broke down right there, you see that it put the market into free fall, right? We came back, re-established some momentum, and began to move back towards the average. And that's something that you guys need to understand about charts, is that it's all about moving averages. Price reverts back to the mean. The middle of this channel would be the mean, and so at that point it began a really strong bullish trend to come back to the mean, which was the middle of the channel. Now, it skimmed along the middle of the channel for a while, and a couple times it briefly broke beneath, but it got these bullish tails, right, which signaled this next move up and out of the channel. And from that point forward, the Great Recession was over. It never came back and retested the bottom of the channel. Once it got to the top side of the channel, this range here, okay, once it got back into the top side of the channel, the worst of the worst was over. So let's just move forward and kind of compare some other recessionary environments, okay? This is a perfect example right here of a very similar thing. It broke down to the bottom side. It never broke through to the middle. It broke back down to the bottom side. It then came through all the way to the top. It then retested the middle twice. And then from that point forward, it continued in a long trend upwards. That was the 2016 pullback. We see the same thing in 2018, and we see the same thing in 2020. In this case, it broke right through very decisively. But when it came back up, it did have some movement between. This was the area where the market was trying to decide what direction it would go. When the middle of the channel worked as support and it failed to break lower, that's when it got really bullish. It came back tested the top of the channel, and then just shot up from there, giving us the highs of 2021. But let's move to the current time frame. This is where we're at right now. And we've already, I just want to point some things out, okay? When we finally hit this top in 2021, we came back to test the bottom of the channel. We got some nice bullish tails pushing us back up. Now, we got rejected at the top of the channel, right? And at that point, it became confirmation that the market was going to go lower, and it went down pretty hard. Now, it did some bouncing along the way, but eventually it came back up to see if whether this bearish run was over, and it came back to the middle of the channel. It did that exact same thing in the 2008-2009 Great Recession. When it got rejected here, it got rejected very decisively, moved back down beneath the channel, but eventually we got a bounce at 34.91. This was October's low. And we came back up and we tested the middle of the channel, and we got some very bearish wicks, and we came back and we tested the bottom of the channel. But this time it decisively held, and this was right around that 3,800 area. This caused a very bullish move up to the top of the channel where we got rejection at 4,200. Now we came back, this became a buy zone, and we did not break through the bottom of the channel. Remember, any time that the market's made it back above this area of the channel, it's never gone back beneath to test these areas or even beneath. It's never gone back that low. Well, we pushed up, and now we've been at the top of this channel, right? For quite a while, it's been very, very bullish. So let's just take a minute and examine what some of the possibilities are, as well as what I said that the smart money has said, that this market, that this year, the market was largely going to finish flat. Right here is January, which was right around the 3,800 to 4,000. And what the market is saying, that it's largely going to finish in this zone. It's going to finish somewhere between 38 and 4,000. And here's what I want to point out to you. We failed, let's say we failed at 4,200 and the market decides it's going to go down from this point forward. It's going to come back to the middle of the channel, right? And it's likely going to find some pretty strong support there, which is really that critical area I gave you guys in the month of January and March, which was that 3,950. So it's very, very possible that we're going to pull back to 3,950, 4,000. And if we did that, we would be making a series of higher lows along the way. This would be the highest. And we then could easily come back, break through the 4,200 after a third attempt, break above it, back test 4,200, and move on from there. And so I'm not saying that this is what's going to happen. I'm just saying that if we compare the last 3 recessions, once it's moved back above the channel, it's never moved back below it. Once it's made it above the middle part of this channel, like when it's failed, it gets rejected hard. Fail gets rejected hard. But once it breaks through, then it stays above from that point forward. So the big question is, what if 3,950, 4,000 is the next low, and that's as low as it gets, and the lowest low was 3,491? That's the question I want you guys to contemplate today. These are not hard predictions, just a long view out of how the charts might play out for the sake of perspective. We don't want to get overly bearish or overly bullish. Let's just stick to the charts as well as the trend until it reveals itself. That's the good, the bad, and the ugly. Let me know, guys, in the comments what you think about it all. Like and subscribe if you made it this far. Go get some free stock on the Moomoo app. Join the chat group there. As always, peace and blessings, my friends. We'll see you in the next video.